The wealth building blueprint. Investing with compound interest. Like planting a financial seed that over time grows into a mighty money oak tree. It's a powerful wealth building strategy that can pave the way for a prosperous future, and understanding how to harness this financial force is essential. We'll explore the intricacies of investing in compound interest, step by step. Whether you're new to the world of finance or looking to fine-tune your investment approach, we'll provide you with the knowledge and tools you need to set your money to work and watch it multiply over the years. So, if you're ready to embark on a journey of growth and stability, let's dive into the art of investing in compound interest. Number 1. Understanding compound interest. Start by mastering the basics. Compound interest is like a financial magic trick, where your money not only earns interest on the initial amount you invest, but also on the interest it has accumulated over time. In simpler terms, it's money making more money while you sleep. It's crucial to grasp this concept before proceeding. If you're new to the concept, don't worry, we're here to break it down for you. Number 2. Setting clear goals. It's time to set your financial compass in the right direction. What are your goals for investing in compound interest? Are you saving for retirement, a down payment on a house, or your child's education? Define your objectives clearly. Knowing your destination will help you chart the best course for your financial journey. Moreover, establishing a realistic timeline is essential. You need to know when you want to achieve those financial goals. Your timeline should align with your goals and set the pace for your investment strategy. 3. Consistent contributions and compounding. Now that you've laid the groundwork for your compound interest journey, let's focus on the practical steps to make it happen. Regular contributions are essential. Set up a systematic way to contribute to your investment portfolio. Automatic transfers are an excellent way to ensure you keep adding to investments consistently, regardless of the amount. Reinvesting your earnings is another vital step. When your investments generate returns, reinvest those earnings. This keeps your money in the game, ensuring it continues to grow and compound. Over time, this interest can have a significant impact on your overall returns. 4. Diversify your portfolio. Diversification means spreading your investments across different asset classes, such as stocks, bonds, and real estate, to reduce risk. A well-diversified portfolio can help you weather market fluctuations and potentially increase overall returns. By not putting all your eggs in one basket, you're setting yourself up for a more stable and profitable financial future. Join our blog, BraylenAV.com, for access to expert tips, the latest updates, and a treasure trove of knowledge. Come along for the ride. We'll see you there. 5. Monitor and adjust your strategy. Investing in compound interest isn't a set-it-and-forget-it endeavor. Regularly monitor your investments to ensure they align with goals and risk tolerance. As life circumstances change, your investment strategy may need to evolve as well. Be prepared to make adjustments when necessary. Rebalancing your portfolio and staying informed about market trends will help you stay on the right track towards your wealth dreams. 6. Stay informed and educated. Knowledge is power when it comes to investing. To make informed decisions and adapt to a dynamic financial landscape, it's essential to stay informed and educated. Keep learning about different investment options, strategies, and market trends. Consider reading books, attending seminars, or following reputable financial news sources. The more you know, the better equipped you'll be to make intelligent investment choices and seize opportunities as they arise. 7. Emergency fund. Before you get too deep into compound interest investments, it's crucial to have a safety net in place. Establishing an emergency fund should be a priority. An emergency fund is a stash of cash set aside for unexpected expenses, like medical bills, car repairs, or job loss. Having this financial cushion ensures that you won't have to dip into your invested money during a crisis, which could set you back on your goals. Aim to save at least 3 to 6 months' worth of living expenses in your emergency fund. 8. Stay patient and ignore market noise. In the world of investing, patience is a virtue. Compound interest is a long-term game, and the financial markets are bound to have their ups and downs. It's essential to tune out the noise and not be swayed by short-term market fluctuations. Stick to the investment plan you and your professional advisor created, maintain a long-term perspective, and avoid making impulsive decisions based on the daily news or market hype. Remember, the power of compound interest truly shines over time. 9. Consider dollar cost averaging. a technique that involves investing a fixed amount of money at regular intervals, regardless of the market's performance. This strategy can help you navigate market volatility and potentially lower the average cost of your investments over time. By investing the same amount consistently, you'll buy more shares when prices are low and fewer when prices are high, ultimately smoothing out your investment costs. 10. Maintain a long-term perspective. One of the keys to successful investing is having a patient, long-term outlook. Avoid the temptation to frequently buy and sell investments based on short-term market fluctuations. Interest works best when it has time to do its magic over the years. Stay focused on your goals and avoid making impulsive decisions that may hinder your overall returns. 11. Risk management. This is a big one. In the realm of investing, risk management is a fundamental component of mastering the art of compound interest. It's the practice of assessing, understanding and mitigating potential risks that could impact your investment portfolio. By diversifying your investments across various asset classes, assessing your personal risk tolerance and staying informed about market trends, you can strike a balance between risk and return. Employing stop-loss orders to limit potential losses and avoiding emotional decision-making are also vital risk management strategies. These practices, when integrated into your compound interest investment approach, help safeguard your financial future while optimizing long-term growth. 12. Seek professional advice. A financial advisor can help you craft a personalized investment strategy tailored to your specific goals and circumstances. They can provide guidance on asset allocation, risk management and tax optimization, all of which are vital components of successful compound interest investing. Choose a reputable advisor with a track record of helping clients achieve their financial objectives. Investing in compound interest is a path to financial empowerment and long-term prosperity. And you can harness this incredible power of compounding to grow your wealth steadily over time. By setting clear goals, diversifying your portfolio and staying patient and disciplined, you can navigate the world of finance with confidence. Remember that continuous learning and professional advice are all invaluable tools in your financial package. With dedication and smart decision-making, you can build a secure financial future for yourself and your loved ones. So as you embark on your journey of investing in compound interest, keep these principles in mind, and let your money work for you, day by day, year by year, in pursuit of your financial dreams. A fundamental and effective approach for building wealth over time. The beauty of compound interest lies in its ability to magnify your financial resources by reinvesting the earnings generated on your initial investment. It is a simple concept with powerful implications. As your money compounds, it multiplies exponentially, giving you the opportunity to achieve significant financial growth. Whether you're saving for retirement, an emergency fund or any other financial goal, consistently contributing to interest-bearing accounts or investments can be the cornerstone of your strategy. Patience and a long-term perspective are key when it comes to capitalizing on the benefits. By understanding the principles and staying committed to your savings or investment plan, you can pave the way for a more secure and prosperous financial future, ensuring that your money works for you and not the other way around.